This meeting is being recorded.
All right, welcome everyone. Welcome to another Rocket Dollar webinar. This is part of our fireside chat series. And what we do with these fireside chats, all of these webinars are about education, but these fireside chats are meant to be interactive. Really getting interaction from the audience, having you discuss back and forth. Feel free to ask questions. We have some questions, we've kind of prepared for today, but always feel free to interject with one in the chat or Q&A, and I'll try and help moderate and get that into the discussion here. So why do we have EquityNet and then Barrett and Raja here today? EquityNet, we'll have Jed introduce them in a little bit, but they really help with new companies and startups raise money. Why are Rocket Dollar customers interested in that? A lot of stock that they see in the public markets, IPOs, we see some fancy IPOs and we see them not work out that well for customers. A lot of that juice or that excitement is already done in the private markets. There are so many companies that are not on the S&P 500 or the NASDAQ that are looking for equity, have great products, are bringing their products to market. And we keep seeing more and more growth in this space. So this is just a fireside chat for our Rocket Dollar customers and potential customers out there. Let's learn a little bit of how a company fundraises today, which is a long process with a lot of involvement from founders. Let's learn a little bit about how EquityNet works today. And then we're going to jump into some founder stories of both Barrett and Raja about their companies. See, they're raising right now. How does that raise work? What are some challenges that they're facing? How are they gathering investors? What does that process look like? So this might speak a little bit to the investor, but also you if you've looked at raising some funds. So Judd, I'd love you to take it away and talk a little about EquityNet.
Yes, thank you, Brendan, and thank everybody for attending today. So I'm the founder and CEO of EquityNet.com. EquityNet was founded in 2005, so it's over a 15-year-old company and crowdfunding platform that has grown to be one of the largest platforms in North America. We feature over 10,000 companies that are very diverse. They range from startups to mature companies with 10 million in revenue, and from everything from crypto companies to artificial intelligence, consumer products, biotech, medical devices, you name it. I even did a search yesterday in our platform for solar companies, and there were 40 privately held solar-based companies. So it is an extremely diverse platform with a lot of deals for investors to review. And because it's so large, we, a long time ago, sought to patent. We have 5 patents on our platform, and to develop via those patents very advanced technology that allows investors almost like a Morningstar.com experience in reviewing those deals. So you don't have to look through 1,000 business plans. You have patented analytics, star ratings, and other risk return metrics. Everything is standardized, so you have a very efficient process to review, to search for and to review what you're looking for, so that you can identify 10 top companies that you want to dive into and learn more about. It is free for investors to sign up and to use, and the platform not only has all of those deals that investors can look at, it also has a great number of tools that investors can use in terms of integrated messaging system to message the companies, to ask them questions, to request any documents that the companies have uploaded, whether it be pitch decks or offering memorandums. And so you have really a complete experience as an investor to search for, identify, review, and then do due diligence, and even messaging engagement with companies, all the way to the point of making an investment decision, all there at EquityNet through a very efficient process.
Great, thank you, Judd. And especially, in that startup or that funding, looking for companies to fund, our checkbook, our IRA LLC customers, they're always, struggling to filter through deal flow. So a site like EquityNet helps people filter, get to the right places, and, really get in touch with the people doing things at these companies like Barrett and Raja. So Barrett, I'd love if you introduce your company first and just a little bit kind of where you're at. Then Raja, and then we'll jump into some of the questions that we had today.
That sounds good. Hey everyone, I'm Barrett Brandon. I'm the CFO of Aventum. We are a venture-backed, premium, high-end, direct-to-consumer bicycle company. If you're familiar with kind of performance into the bicycle spectrum, we make road, gravel, and triathlon bikes. They're highly customizable and they're built here or assembled here in the US. Over this, we're entering our 8th year as a company, and our compounded annual growth rate is just around 50%. And so that's kind of where we're at and how we've been able to scale so far, and looking to continue, our growth trajectory and in the next few years.
Great. And one of the things, at Rocket Dollar, which we're always really trying to champion, is trying to give more access to invest in what you love or what you know really well. So just like, again, any cyclist in the audience, looking at an S&P 500 company, maybe you work in that industry, maybe you sort of understand what's going on in some of those industries, but like any of our customers at Cyclists can immediately understand Barrett's company. And that's what we really love, is getting our customers into things that they love. Raja, why don't you take it away? You are obviously very into food, and customers that might be into food or food science.
Well, thanks, Barrett. Appreciate everybody being on the call and appreciate the opportunity to talk today. So Raja Ramachandra, and co-founder and CEO of Ripe.io. We're a little over 4 years old. And, we've deployed technologies to fundamentally answer questions about where your food came from, how did it get there, how was it transformed, is it safe, what kind of quality is it, what is the sustainability practices that support that food item, and so on. And so in effect, we've created, a digital mirror of what actually happens in your tomatoes and your cans of soup and pork and so on. And so, our business model is that we charge our customers, who range from farmers all the way to large CPG companies. We're a SaaS, and so there's a SaaS fee that's associated with it. And we also charge for data record management on the on the system as well. And really, the value proposition for the varying customers on our platform range from supply chain efficiency, understanding how transparency fortifies quality assertions and pricing, and all the way to enabling the proof of sustainability, which has become a much bigger deal today. And we've been able to grow over the past 4 years, and I look forward to working with the folks at EquityNet here on capital raise.
Yeah, and a lot more smarter shoppers getting out there that are looking at their food, researching where it's coming from, or just making better choices about where they're buying it from, supporting with their dollar. So Judd, we talked a lot about EquityNet already. What is EquityNet? But I've seen a common challenge that the founding teams like Barrett and Raja first experience is when they approach some of these websites online to raise. Sometimes there's huge commissions taken out, or arrangements that can suck a lot of the raise money out of the deal. So how do you set up EquityNet, and what are some of the ways other fundraisers will see when they approach the marketplace out there?
That's a good intro. Several of the platforms in the industry are commission based. Mm-hmm. And so they charge 7 to 8% of the funding raised. That does not go to the company, and that comes out of the investors' funds and goes straight to the platform. And so that is quite expensive cost of capital. In addition, those platforms generally do not have a large accredited investor base like we do. So they also expect and require that the listing companies spend tens of thousands of dollars on advertising like Google Ads in order to drive traffic to their profiles on those platforms. We are wholly different. We are not commission based. We are a flat fee platform. We believe we're leading the charge, more or less like Ameritrade and E-Trade and those entities led, and now Redfin, from what was industries that were all commission-based, high commissions, to more of a technology-based platform that can offer flat fees at a relatively low level, a low rate, because we have automated so much of the experience and reduced the labor required in order to make these funding pursuits successful. So our entrepreneurs can start for free, but to use all the premium features, all the tools that we've developed. It's a flat monthly subscription. There's a DIY, and there's also a full service option if they want our team to assist them in an expert level with special promotions and daily support and activity with the founding team. We also have that option. And because we're flat fee, it also gives our companies a high degree of flexibility in how they promote their offerings on EquityNet and across the web. And so the commission-based platforms have to deal with a lot of regulations that restricts how they operate and also restricts how the companies can utilize their platform, whereas a flat fee platform like EquityNet is quite flexible for us as an operation and for our companies in using all the tools and capabilities that we have.
Yeah. So thank you, Judd. And just know that when you're talking to a young company as an investor and you're asking like, hey, I'd love if I want to give you a check from a Rocket Dollar account, but why aren't you on this platform? I kind of want you on this platform. Just know that like with some of these founders are faced with, well, I'd love to raise in that platform, but then I'm going to lose 5-6%. If I'm going for $1 million and that's my runway, or 5, 6, or 10 million, how much might get cut out of that just for the privilege to raise in a certain platform? So we're really big on flat fees at Rocket Dollar for our customers. Just know that, all across other areas of fintech, sometimes the consumer side gets really price effective very quickly. But I mean, that's why like Stripe came about, was the business side was still terrible pricing. So good to see, that you're working on things like that, Judd. I want to ask a question first. What's something more like a friends and family round, versus like a series A or B? What do those look like? Barrett and Raja, I'd love for you to talk a little bit about that, and then kind of tell us where you're at in your current race.
Sure. I guess I can jump in and start. I think the most, I think venture capital and friends and family and angels and all of that has kind of bled in the last, 5 or 10 years with Silicon Valley, and it's a lot of numbers thrown around. I think, in general, you have some sort of seed capital, whether that comes from the founder, whether it comes from your friends and family, maybe whether it comes from an angel. Generally, it's pre-revenue through some modest amount of revenue. And then as you gain traction and growth, you can move in towards more like real traditional outside capital from VCs, private equity. A lot of that is kind of your development, your Series A. As far as what that looks like, I think it's all over the place. It varies by industry. I think as you get into a Series A, you're looking at probably 1 to 2+ million, if not more. These days, those numbers keep going up. And then as you kind of grow and your company grows, those round sizes get larger until you either IPO or some other exit, an acquisition, a sale to a middle market private equity company. There's a lot of options for exits depending on your industry. So I think for Ventum, we were founded, the founder self-financed the project for the first 5 years. And then we had our first round of outside capital, which was, around a small Series A. We did a few $1 million of that in 2019. And that's, where we're at today. And the current situation is we're looking to kind of fund the next stage of our growth. And we're on Judd's platform on EquityNet, trying to find the right partner to help that. And that's where the company is. But I think that, where we are in basically our stage of growth is we're looking for growth capital, and to go from, I mentioned our growth rate of around 50%, but we want to get, close to 100. I think we can do that with some supply chain optimization and some other capital infusion. So we're trying to find the right partner, and we're casting a wide net. So it means platforms like EquityNet, it's pounding the pavement and talking to a lot of people. And as anybody that's on this call that's an entrepreneur knows, you have to deal with a lot of no's and a lot of difficulty. But we believe in the product and the business, and we're super excited about our future.
Yeah, great. Thank you, Barrett. And something for the audience, if you're an audience member and you did like a Series A or friends and family like 10 years ago, expectations have drastically changed over the last decade. I don't remember all the stats, but just hearing our CEO Henry talk about it, expectations have grown on the size of deals and where certain investors slot in, and some that are kind of trying to think in that 10-year-old mindset have been pushed out or have to go earlier or later, depending on where they slot in. So Raja, I'd love to hear how your path is going, kind of where your company's at right now.
So yeah, we also went through, I'd say, a fairly typical process of friends, family, seed round, and we're in the middle of an A round right now. And so, to echo what what Barrett said, I think it's true. It's this whole notion of friends and families become complicated and blurred, meaning I think the base is widened quite a lot. And so, what tends to be angels, or even now crowdfunding, or even crypto investors, right? There's an opportunity to tap into pools that so-called make up this notion of friends and family. I think, the objective with that round is that you have a pretty solid idea, particularly if you've had experience in those markets. And what you want to be able to do is either get a first version of product done that has a decent amount of market fit or can be tested with customers. And so it's a very low cost way of being able to leverage whatever money that you put in as a founder, with people that basically believe in you and the originating team. Certainly have some interest in what your idea is. And then ultimately that leads to things like seed, or hopefully your first set of customers. And so we went through that process we had a pretty broad network because we come from the financial trading industry. And so we had a number of folks that we were able to tap into to help us build a team, finish out a really, really limited version of the kind of a proof of concept of what the product would be. And that was strong enough to enter accelerators where we got our first customers. And then once that happened, then it was time for us to get a seed round. And we raised like 2.4 million. That included the angel investors because they're all in convertible notes into the round that was in 2018. And we were on a pretty decent track to raise an A round, and then COVID hit and everything just sort of slowed down. So post-COVID, we've gotten aggressive again to look at an A round, and we're thankful we're on platforms like EquityNet to reach out to investors. Great,
thank you. And so when you're reaching out to these investors, this is a common question in almost every webinar. As a new startup, we're talking about all these different avenues, but a lot of them still do require accredited investors. And one thing I always want to educate the Rocket Dollar audience is why that's there. It's not always the company just trying to be an asshole, like, oh, we don't want your money. There are regulations that sometimes make it harder to raise in certain platforms or to raise to non-accredited investors. So Judd, I'd love if you, we always do a super quick 101. We've done that in some previous webinars, but again, what is it accredited? And what does that look like now in the landscape of both EquityNet and the wider market?
Yes, very good. So the first thing is EquityNet focuses on accredited investors. So all of our investor base are accredited, which means companies like Barrett's and Raja's are working with investors that are going to typically do investments of 10, 25, 50,000 or more per person. So it's very different than raising money on, say, Start Engine or WeFunder, where you're getting an average of maybe $500 per micro retail investor, non-accredited. The SEC has had the same definitions or qualifications for accreditation for some time, although I say in 2020 they added a new one, so they expanded it. The standard one is income-based, that you make at least $200,000 per year for the past 2 years, that you have a net worth of over $1 million, and you don't have to have both of those. It's any of these. If you match any of these qualifications, then you're considered accredited. So $200K in income, $1 million in net worth, excluding primary residence. The other one that's always been around for a while is if you manage a trust or a partnership, or work for a bank, a corporation with assets over 5 million. So you basically manage money. The new one that they added, the SEC added, is they updated the rules in 2020 to say that you can qualify based solely on financial sophistication, as defined by measures of professional knowledge, experience, and certifications. So, for example, if you're a CFA or you have a Series 7, or you more or less are pretty experienced in the financial world and these type of financial investments, you can qualify without having those numerical qualifications of income and assets. You can qualify simply upon having the right level of experience. And that's opened the door for people who maybe are particularly younger, who haven't reached 200,000 income or $1 million in net worth. So that's been a good expansion of the definition of accredited investor.
Great. Yeah. And, I'd love, Jed, if you're marketing to a non-accredited investor, could you talk about, maybe not all of them, but don't some of the regulations bump up immediately about how your raise can be structured and how you have to talk to non-accredited investors?
Yeah, if you're doing like what's called a Reg CF or crowdfunding round, that's dedicated almost exclusively towards non-accredited investors, there is quite a bit of regulation that comes along with that, in terms of having to file various forms with the SEC, and probably take several months to prepare for that. And that's generally focused on companies like WeFund or Start Engine that I mentioned earlier. But that's only one of the exemptions under which you can raise capital. There's also called Reg D, that's been around for decades, and Reg A plus. Those are also two other exemptions under which companies can raise money. And still to this day, Reg D dwarfs the volume of Reg D offerings and transactions dwarfs Reg CF, because a lot of companies just find Reg CF to be too costly, too onerous, and they don't want to have to spend tens of thousands of dollars trying to accumulate 1,000 individual investors with $500 a piece.
Yeah.
They'd rather go the more efficient route of a Reg D offering that doesn't have the complicated requirements, and focus on accredited investors only.
Yeah. And, Rocket Dollar went through a crowdfunding round. And this will kind of segue what I want to talk Barrett and Raja to talk about, but that took our, operations. We were for a good 3 to 4 months, 3 definite months where that was really the only major task that we were working on. Anything outside daily operations, crowdfunding campaign, the exec team organizing the crowdfunding campaign, getting all the documents in, getting all of that reporting done. It really did occupy us for quite a while. We got a lot of investors from it, thankfully, but it did take so much work. So thinking of that work, often we want the startups, you have to think as an investor, you want your company focused on what they're doing best, creating bicycles or tracking food. So the founders can't be distracted constantly from the fundraise. They need to be able to get back to the actual company itself. So Raj, how about we do you first this time? I'd love you talked a little bit like an initial pitch about how you track food, but when you're talking to investors and trying to help them fully understand your product, what are you working on day to day?
Well, I think the easiest way to highlight what we do is we just reference our customers. Because what we do in some sense is it's complicated to discuss, because you're stapling together a lot of disparate data from multiple parties within multiple geographies that somehow make up what you see in a grocery store, or what you get delivered in a restaurant. So in that sense, typically what we do is we show the use cases and the value proposition of a client. So whether it's a farmer, or it's a packing company, transportation, processing, a feedlot for beef cattle, these are all things that people have no idea about, right? You just see your food, and even the ones that are most discerning and try to investigate what they do, you are going to find, if you really want to dig into it, you will definitely find a lot of information that you can't get to. And then you're going to have a chemistry degree to actually understand what's actually in that food from a quality perspective. So what ends up happening is we showcase what's the placement that you have on the supply chain, say farm to farm gate. So things are harvested, packed, ready to go. So there's discrete information that goes there. If it's more for processing and then showcasing food safety as an item, we show what that data could mean, and what does it actually mean as value to the companies that need that record for compliance, for reporting management, to avoid fines and so on. So you can quantify what that value is. And then what we don't do is we don't serve the end consumer. We provide the data for that aggregator of the consumer, whether it's like, a Walmart or a retailer, like a restaurant like Sweetgreen. In the end, they know their customer the best, and they can use this data in any way that they choose. So in that sense, we are really a data engine that mirrors what actually occurs that is underlying that food item itself. So in terms of how we represent ourselves to investors, I think the first thing is to say, this is how the customer uses it. These are the value propositions that they're getting, whether it's supply chain efficiency. Sometimes they even get market share increases because of transparency, and a number of other items that are there. So I'd say that that's probably our biggest way in which we try to showcase a lot of that.
Great, thank you, Raja. And I just want to ask a quick Q&A, and then we'll have Barrett go. So Mick answered, thank you for the presentation. Would you mind recapping a fee structure with on these types of investments for Rocket Dollar customers? So we're really big on flat fee investments here at Rocket Dollar, $360 to open an account, $15 a month. That means that if you see 5 startups, or you see 2 startups on EquityNet, you can go. Basically, you're not paying a fee to Rocket Dollar to send money to their investment. If you have to do a wire fee for $25 because you need to rush the money there, that's it. We do not charge it per investment fees at Rocket Dollar with our IRA LLC. And then we're working on improving our direct custody IRA as well for our California customers, so they can get an IRA that has no per investment fees as well. So Barrett, we had Raja kind of talk about what he's doing here. How about we jump into the bikes, and who are they really made for?
Yeah, thanks. I think for us, one of the easiest things when we're talking to investors is just general knowledge of the product. Most everyone understands what a bike is, so you don't have a lot of explaining of this complicated, if it's business, B2B or what you're doing. We sell bikes, so that's pretty simple. So essentially we try to show them or tell them how we are a better bike company, a more efficient bike company, and the better value proposition for the customer. And we have our traditional kind of pitch. We go through the market problem, why some of the legacy brands are slow to react, why they offer limited choices, how their distribution model is antiquated, and then how we can solve that. We feel there's a tremendous market opportunity, and we try to, show that in kind of the TAM, the SAM, the addressable market that we can kind of tackle in the US. I think in the last 2 years, you've seen, with COVID, the trends in micromobility, health and wellness, and, kind of this enthusiast market exploding. And so we see those trends continuing to continue post-COVID, especially as people are outside, and have that need to build that community and interact with people and do events. And so we kind of highlight where we see the market is going and how we can go from a pretty small D2C player in the market to one of the larger, bicycle manufacturers in the US and eventually the world. And so we kind of walk them through that process, where we are, how the last 7 years have gone, and what we feel we need capital-wise to execute on our mission. And that's what we're doing. And, to your point or your question earlier, well, I don't know if it was a question or a point, but basically it is really hard balancing the day-to-day of running the business and fundraising. There's just no two ways about it. It occupies a lot of my time, a lot of our CEO's time, and it's a distraction. But at the same time, it's a distraction that, if done right, and if we execute and we're successful, then it will set us up on our growth path for the next 5 years and ultimately help us exit. And so it's necessary, but it can be stressful. It can produce a lot of gray hairs and sleepless nights. But it's one of those things that it is rewarding, and there is kind of an end date, end goal in mind, which is always nice.
Yeah, thank you. And at Rocket Dollar, I always joke you can feel when the fundraise is coming up, because our exec team is a little bit antsy. There's a little bit of stress going on, and the Rocket Dollar employees like, wow, everyone's a little stressed out right now. It's like, yeah, because they're just trying to wrap up something pretty big. So Bear, where do you really reach your end customers? Raja talked about he's kind of B2B, at the beginning or near the end of the chain, but where do you actually, your end users, are they really like triathlons? Are they racers?
Yeah, so our pitch, yes, we do sell to triathletes, we do sell to high-end racers. Our bikes have been at the highest level races and in a broad spectrum of cycling disciplines. But our position is whether you ride for performance or you ride from fitness, you don't want to ride slow. Even if you're riding with your friends to a coffee shop, you want to beat your buddy, or you want to get there faster, or you want to go up the hill easier. And so the idea of this performance category, we feel it kind of transcends only competition. And so, we find our customers a lot of different ways. Obviously, our primary distribution method is directly to the consumer through e-com website. And so, we have to kind of put that against the price point. If you're selling $100 pair of sunglasses, you can serve a few ads, and somebody might, on a whim, buy a pair of your sunglasses. And if you're selling a $7,000 or $8,000 performance bike, they're probably not going to buy it on a whim from an Instagram ad that you target them for. Mm-hmm. So I think there's we're finding ways to build community even as a D2C kind of e-com company, through events, through kind of road shows, through strategic pop-ups. I wouldn't quite call it omni-channel, but that's kind of the next phase of the growth, is how do we build that customer base and that customer awareness. And so we find our customers a lot of different ways, but we firmly believe that while you can be a performance product, even if you are an enthusiast or not an athlete trying to compete at the highest level, those aren't mutually exclusive.
Yeah, and one question came in from Mick Lowry live. He's just asking, what's the average sales price per bike? If you don't mind sharing price point.
Yeah, no. So our AOV is around $4,500 as of a few months ago. That's definitely going to go up as inflation goes up and the cost of bikes is skyrocketing. Our raw costs and our vendor costs have gone up 20% in the last year. So yeah, our AOV is around 4,500, excluding soft goods and other things. So that kind of gives you a price point of where we primarily sell.
Great. And I did about, might not seem a lot to a very enthusiast cyclist, but in the first few months of COVID, I did like something like 500 miles just to really run out the boredom and the stress on a 15-mile Austin pathway. That's where like a lot of the enthusiasts go in Austin, as they drive over and start out there. But to see the growth just on that path alone, a lot of the regulars out there was really interesting. Casual people getting out there, getting all the way to mile 13, you started seeing more people showing up there. Okay, so we talked a little bit about, I wanted to share a little bit about Barrett and Raja's like actual company operations, because I think that's some of the most interesting things we can speak about on these webinars. Raja, you mentioned a convertible note earlier, I believe. I just wanted to talk a little about what a convertible note is, and why would a company seek one out? Because we have a lot of investors that might have considered it or might not know what it is. But why did you seek a convertible note in the past?
I mean, I'd say the three reasons. Number one, convertible note is really a short-term loan, for lack of a better term. It's a promissory note with a bunch of terms and conditions that are associated with it. And so for a lot of accredited investors, particularly institutions, knowing that we're trying to fulfill against an A round, quite often this is a way for them to step into the company until that conversion actually occurs. And so, we chose it because certainly we needed the funding, prior to a full close of an A round. And so this actually provides us capital to operate. May not be able to grow as quickly, but take advantage of customer opportunities, any kind of technology build, some staff that you want to get through. And so it's really a good, like for us, it's been a good way to help operate the company in lieu of finalized VC capital in an A round. The downsides of it are that it is debt effectively. It is convertible, and so in that sense, new investors are going to look at the totality of that amount, and if it starts to get a little hefty, it sort of ruins their ROI perspective, because they are going to get diluted once these get converted. And sometimes the conversion rates are often at discounts or favorable terms to the actual convertible note holder. So, the good and the bad of it is that it certainly provides funding through the process of closing a round. And the downside is that you have to balance it with not taking in too much, and making sure that you can balance keeping the company, going in its normal run rate. And so yeah, I mean, it's a tool, and there are varying forms of it. There's safe notes, which have less paperwork per se. Our convertible notes were pretty well vetted at an institutional level, and so there's quite a lot of terms and conditions behind it. But yeah, I would say those are the predominant components of why we went down this path of convertible notes.
Great. Yeah. Thank you for sharing, Raja. And Rocket Dollar has gone after notes in the past for when, Henry, our CEO, is just, we have a complex product and we need the right investors. We need investors that understand that product and really where we're trying to go with it. It's not a standard retirement product. And it's not just like a standard, like a Robinhood, that many fintech investors that might have just owned one or two fintech deals, like that's what they're used to. So, Henry was using those as a bridge to get somewhere, saying, okay, we've got runway, we've got a little bit more time, and that gives us time to operate the company, but also find the exact right investor to really hit it out of the park. So Barrett, has your company ever explored a convertible note before?
Yeah, convertible notes and safes. I think, as Raj mentioned, I think one of the other things is if you haven't gone through a VC or institutional round or Series A round before, I think maybe there's a perception that you can knock it out pretty quick, but a lot of times these things can take 4, 6, 9, 12 months. By the time you search something out, you find the right partner. I mean, for us, it took us, once we found the right partner and signed a term sheet, it took us 6 months to close the deal, our first, like our initial outside capital. Whereas safes and convertible notes, as Rod mentioned, convertible notes can be somewhat lengthy, but they're still generally quicker and less paperwork than equity agreements. And so, if you're looking for bridge capital or something that is, a little easier and you want to punt the valuation down the road, convertible notes and safes are ways to go for kind of incremental funding, and can be really powerful. But yeah, like anything, you have to monitor the amount of equity you're giving up, and what the promise of a future price is always kind of the scary part. But yeah, we've looked at those. We're entertaining them now. If the right partner came along and the right amount for our next kind of incremental funding. But yeah, there are definitely a lot of different ways. There's debt financing. There's LOCs. There's a lot of different ways that you can create capital. And I think for us, it comes down to kind of the weighted average cost of capital. Like what is the agreement? What is the cost of capital? What do we give up? What do we get in return? And how does it advance the business forward? I think that's how we look at outside capital.
Yeah, and that's how does that advance the business is a common thought in founders' minds. So Barrett, I'm sure you've obviously thought about this, but as you have a deal that you're putting out to investors, those discussions can always evolve as certain investors pop their heads up. If you really get the right investor, they really understand your company. Sometimes something could start off as more of like a bridge conversation and turn into a more like anchor type investor. So Judd, how much of when you're looking at people raising on EquityNet, how much of that is notes versus other styles of fundraising that people are utilizing?
Very good question. Despite our name EquityNet, that being equity, we have around 10% of companies are seeking traditional debt or loans. Around, say, 30% are seeking, or 25% are seeking convertible notes and safe notes. Safes are a form of convertible notes, as the gentlemen have described. Around 60% of companies are seeking your kind of standard equity offerings, and then we have a minor percent, less than 5%, that are doing revenue sharing offerings. So it's pretty diverse, but it's heavily focused upon straight equity and convertible notes is the majority of the activity on EquityNet. Because they're correct, convertible notes are technically in the interim debt instruments or loans, but they eventually turn into equity. So they're a hybrid. Longer term, they are an equity instrument as they convert. I'll also note to everybody on the call that if you're interested in looking at Barrett's company Ventum and Raj's company Ripe.io, they are readily available for view, or their profiles are available for view at equitynet.com on our homepage. So feel free to go to equitynet.com and you can check out their wonderful companies and videos and pictures of their product and other information that I think you'll find very impressive.
Yeah, so I just put that in the chat for everyone. You can see Ripe.io right there. Ventum, you just got to scroll just one or two scrolls. You'll see both of them. So feel free to check those out. We got another question. This is becoming a common one each webinar, just because it changes the environment that we're in. So Barrett, you mentioned a little bit about higher interest rates. There's the supply chain stuff in that. There's just general inflations and higher interest rates. So, how are your two businesses really looking at higher interest rates and inflation? And how is that presenting a challenge or maybe an opportunity for your business?
Yeah, I mean, I think for us, it's the supply chain mess that's kind of driving some increased prices are causing far more issues with our company and delivering goods than a small increase in prices. We are, it's disposable income. We don't, it's not food. People choose to buy a bike if money's tight, they necessarily won't. So we realize that. I think the real question is what kind of can the market bear? And our competitors are raising their prices as well, and so we're still very, very competitive. Even for how small we are on a price point, we don't like to compete on price. We like to compete on kind of the value proposition, what you get, what you feel like you're a part of when you join our brand. That's a big distinguishing factor. And so I think that as inflation goes up, as prices go up, it's something every company has to deal with. And is your target customer still willing to pay for your product? And for us, and where we see the bike industry heading, if we continue to make compelling products, have a compelling brand, have a rabid kind of community that wants to be a part of us, then there will still be that demand for the product. and it's not, while everyone's price sensitive, it's a little less so on that front.
Great, thank you, Barrett. And Raja, we're seeing all these. People are familiar with some products and some they're very far away from. The grocery store is something they're always familiar with, and we've seen a lot of news headlines about inflation. Maybe food isn't getting from a certain area of South America or China or not going the other way. So how maybe not inflation affecting you directly, but how is that impacting both your business and your partners that you deal with?
Yeah, I mean, I think inflation in an essential product like food is a complicated, answer, because in some sense, from the consumer side of things, the total effect of inflation on your discretionary income is probably a key thing. And most people generally don't really keep track of that. I mean, they have some sense of how much I'm paying for gas, how much I'm paying for food, what about my capital goods, what about healthcare? What about my kids and so on, right? And I think that anecdotally, over the past many years, I think if one were to look at your grocery bill, I think the litmus test is, I used to have 3 bags of food that I paid X for. It's now 2, and so that's very particularly so for something like Whole Foods. So I think that, what ends up happening is that, it's not gotten to a point where the inflationary effect squeezes out that level of discretionary income where it says, well, I'm going to not buy that steak, or I'm not going to buy these new veggie burgers or whatever. For certain thresholds of income status, yes, that's going to make there will be an impact. But inflation is really not the one that's like doing it. It's more a function of, what is your purchasing power? What is your what's your job situation? Are you being promoted? Are you getting, what I mean? There's a whole series of questions. So on the consumer side, again, I think ultimately is, where do you feel the pinch in the pocket? Generally it tends to be your gas prices and your food prices, and you kind of, are aware of that. On the business side, it's a different creature altogether, because the way the elasticities of price impact on inflation is so different and cascades very differently across the supply chain. I think that if you're a high inventory business, you will feel it unless you've already had your CFO provide immunity against it. And there's a lot of ways you can manage your interest rate through interest rate swaps and a whole series of items where you can, mitigate the effects of these types of things. So I think inflation is one of those things that gets a lot of headlines. I think the most troublesome part of inflation is that people try to attack it in different ways, whether through government fiat or, policy. And generally what ends up happening in the supply chain is once inflation is there, it's kind of this hidden killer, like, cancer in a way, is that if you're not careful, the next thing you know, you're going to reach double digits, and it becomes incredibly hard to combat. And then all of a sudden you're left to the Fed to figure it out. And so what ends up happening is you get effects like the president meeting with meat associations and meat providers and going, you guys are charging too much. That's not an inflationary issue. It's more of they try to frame it in competitive. I think a lot of that is going in the food business, and also the food business in and of itself is lurching forward with all these alternative proteins and alternative non-protein based liquids and so-called meats. And those prices are high, they're not exactly cheap. And so again, the stream of people that can afford it, I wouldn't say that there's an inflationary thing. They've just looked at a new pricing equilibrium state that defines that food category. For unfortunately, the lower end, of income in the economy, food quality as correlated to price, continues to suffer. And so, in that sense, inflation will have an impact there potentially. Again, it's going to come down to discretionary income.
All right, thank you, Raja. And that's just thank you for indulging that. That's a question every webinar now is, from the Rocket Dollar perspective, these are people's retirement accounts. So they're worried about inflation on their personal day, but they're also worried, especially about cash positions or certain assets they have that are a little bit more vulnerable as interest rates change or rise. So people that have a lot of bonds, People, a lot of our investors, obviously, they have tech stocks in their stocks portfolios. Some of those took a hit in the last few weeks. So people are trying to think of, okay, this is kind of a new era of we've had very low interest rates for a very long time. We're finally getting some inflation. How does that impact the assets in my current portfolio? How does it impact the alternatives I have? For a lot of our investors, they're already into alternatives. Now what they're trying to do is they're asking every webinar, and through this education, they're trying to find out which alternatives are great defense against some of these forces in the next 2 years, 3 years, 5 years, 6 years, 10 years. So we have time for maybe one more question here. Mick was just, thank you, Raja, for your answer. He really enjoyed that one. All right, so our last question I'll have is, we kind of talked about how deal size is changing. We mentioned that a little bit at the beginning. What someone sees as a friends as family, there's all these avenues that's growing. What's a Series A, a Series B is, expectations have drastically evolved as far as the size of a Series A and B. So, how does deal size impact, how you're currently raising right now, Barrett and Raja, and Jed, that you can finish off maybe how that affects EquityNet raisers.
Yeah.
Barrett, why don't you take it away?
Yeah, I think that deal size is something that you don't think about. You think, oh, $20 million is harder than $10 million, which is harder than $5 million. But I think you have to match deal size with your audience. And if you're approaching friends and family, or even family offices, or EquityNet, something like that, trying to raise $4 million from friends and family is a lot, right? Trying to raise $4 million from a middle market VC company or private equity is really small. And so I think you have to know your deal size, know your audience. As deal sizes have increased, the complexity of the deals tend to increase. And I think, as you get up there now, the idea of, hiring bankers to represent you, and it's not new, but, I think you have to start thinking about that as you get into later rounds of funding, which costs money up front. And so, it's interesting. I feel like this is kind of at an inflection point, the whole raising process. You have platforms like EquityNet, which would allow you to kind of crowdfund or get that A, B, late seed type funding, perhaps without hiring an institution to represent you or going and roadshowing to larger companies. So I think deal size is important. It's very nuanced, and it's probably, for us, to be frank, the last 6 months, it's been the one thing where we've struggled with to try to find the right deal size and the right partner. We don't need too much capital, but we do need a little bit. And so trying to find that right balance is really key to a successful raise, I think.
Great. And, from the Rocket Dollar perspective, we're always struggling with that of, again, a complex idea, a complex product of an IRA that we're putting out there to the world is, we want to make this, it's complex now, we're trying to make it simpler. We were worried if, we gave up too much control of the company, or we took on the wrong investor, we might lose control of that vision. And all of a sudden we're veering off into some way that wouldn't be the best for us. So, founders are always grappling with that. It'd be great to have $20 million, but if you give up so much equity for that, sometimes your business direction can fundamentally change in a way that might not be the best for you. And that, 20 million might have been a curse, anchor around your neck. So Raja, any commentary on deal size and those challenges?
Yeah, I mean, our approach to deal size is bottom up. I mean, typically what we do is we take a hard look at like, what milestone are we trying to reach, and how long do we estimate that we reach such a thing, whether it's break even or, some rapid, repeatable growth in your sales or things like that, right? Or release of a product. And so then you can start to look at your run rate and what resources you need to achieve that. And then you can start to look at, okay, if I need X, great, call it 3, 5, 10 million, whatever it might be. Then the second part of the analysis is, number one, you take a hard look at a gut check about how much equity are you really willing to give up. And that's a function of what your valuation is, so once you determine the amount, then you start to look at what's the valuation that meets your own personal goals as an equity holder in the company. Then you start to talk to your advisors, your law firm, any entities to benchmark, well, what kinds of VCs one fit, what we do, right? And that's really probably the hardest part, is ensuring that you get people that understand, what it is, even though they may purport to say that, it's not entirely true. Second, what are those check sizes, and what's their velocity and speed in which they can, do something along those lines? And then, how do you go about syndicating a group of people that have maybe never worked together or so on? Ideally, you get a lead and then they go on from there. And so what ends up happening is that's where you're going to balance out, well, does someone buy your valuation, which then cascades quickly into, does that fit our equity profile that we're willing to give up? And do we have the capital necessary to reach our goals? That balancing act is crazy hard, right? I mean, every startup goes through that. So, by no means are we unique, and I think that's been largely our challenge, because we have two elements that are interesting about our business. I mean, we entered the market as a blockchain, sort of technology company, and that had its pros and cons. That's shifted now. Blockchain is far less important as opposed to, well, what's the data and what are you doing with the company? And so we found ourselves a bit in the crosshairs of that evaluation by VCs, like, well, what am I really investing in? And so anyway, I think we've gotten to a place about that. But anyway, that's sort of our process in terms of, figuring out deal size, right? Because it has to have some grounding and rational basis that you can pinpoint to as to why you're spending this money and what does it get you.
Great. Thank you, Raja. And you'll really see when we talk to really professional investors here at Rocket Dollar, some of our customers are pros, others are doing this for the first time. When I talk to a lot of, who I think are pros who have done this a lot, they often find themselves slotting into a certain deal size, especially as a startup new company investor, and they tend to stick there because they really kind of learn that territory. They learn what the company needs are. Again, bicycles to food, but if they're going in the same deal size at the same about stage of the company, that investor is really educated on how to invest and also how to potentially maybe help that company succeed and get to the next level, specializing there. So Judd, let's close it out here. I'd love if you talk just a little bit about deal size and EquityNet, but thank you so much for everyone for stopping by today.
It's a very good question. And given that EquityNet has thousands of companies, it's a very diverse base of companies. A number of years ago, we developed a really nifty interactive charting tool that's free. It's in our resource center. If you go to the footer of our homepage, it's called Funding Statistics. If you click on that, you can chart funding goals, valuations, revenue. You can dissect and look at what the business domain within EquityNet or representative crowdfunding looks like. And so if you look at 15-year trend data on funding goals, funding sought, let's call it, in the last 10 years, it has gone from 1.8 million to 2.6 million. If you look at it segmented by industry sector, by 12 different sectors, you'll see that on the low end, consumer product companies are on average seeking a little over $1 million. And at the high end, energy and utility companies are seeking almost $4 million. And that's to be expected because energy and utility companies are very asset intensive. They have huge infrastructure investments to make in building their asset base to offer, their product or service. And so anyway, I would invite people to look at the funding statistics in the footer of our website to look at all these stats, and they're all updated through 2021 and interactive. It's pretty nifty data. But one more point, I think part of the question was, how does the size of the funding round affect what type of investors you're approaching? And, on our platform where you're dealing with accredited investors who are going to invest at least 10 or 25,000 a piece, if not more, a person. If you're seeking 1 to 2 million or more, it's reasonable to complete that funding round from these individuals, because you would only need, at 50,000 a piece, you would only need 20 investors to accumulate $1 million, which is not excessive number of investors. If you're some companies in EquityNet are seeking 5, 10, or 25 million, then you're probably looking at better targeting, maybe a mixture of wealthy individuals, family offices, angel groups, and venture capitalists, which EquityNet features all those types of investors. So it just depends on the size of funding round. But yeah, if you're seeking a large amount, you're probably going to have to work a while if you want to accumulate all that from individual investors, even if they're accredited.
All right. Well, Judd, thank you so much. I know you helped organize this today. Thank you, Barrett and Raja, for joining us. Just so you know, everyone, this will be on YouTube. As always, everyone emails and says, hey, I had a couple people email this morning. Is this going to be recorded? It will be on YouTube in about an hour from now. So feel free to share that with anyone. If you like the story of Barrett and Raja's company, or you want to check out EquityNet for yourself or your others, please just feel free to share that on LinkedIn, social, wherever, people you think that would care about it. Thank you so much, everyone. Barrett, Raja, Judd, thank you for coming today.
Thanks, everyone. Thanks, Brian.
Thank you. Bye now.
Thank you.
Bye-bye.